Well, it's a dangerous game to make stock market predictions, and I really don't encourage financial planners or insurance agents or really anybody to make predictions about the stock market. But I can tell you, we can certainly reassure our clients that the financial markets are functioning, and there's lots of exciting GDP growth ahead of us, especially in the BRIC regions, Brazil, Russia, India, China. So, we can look at things like some papers that have been published in the last year that might give us encouragement we could pass on to our clients. And I found a really interesting paper written by Rob Brown. He's a PhD from Northwestern University. And he wrote this paper on this whole debate of active versus passive management. This is a very relevant debate for us as financial planners and insurance agents, reassuring our clients that the stock markets are not only functioning, but not to give into those temptations of putting too much money into stock market indexes. Stock market indexes are a lower cost way of getting into the stock market, and often they're going to bypass the products that we can offer them as insurance agents. And so what can we do in 2010 to reassure them things are going to be good, or at least they're going to function, and that we need to continue to trust the advice that we're giving them to use the active managers that we've chosen? Well, this paper by Rob Brown goes through what really I'm calling a perfect storm for active management. He looks at 4 trends in particular. The first is the whole Madoff scandal, and sort of the failure of some of the investment managers, the big investment managers, to serve their clients and the fiduciary interests of their clients. And so investment management committees, in light of the Madoff scandal, really went back to their investment managers and asked them for full disclosure. And so full disclosure is something we're seeing over and over again in the investment world right now. Well, that is not good for an active manager. An active manager needs some privacy. You need that privacy to set up your position and then wait for it to mature, and then you can liquidate your position. And so if you have to give full disclosure, all the other substandard managers are going to just follow what you're doing and bid the prices up. So that was the first thing he talked about in his paper. The second thing is liquidity. With the fall in 2008, many pension committees got nervous, and they wanted reassurance that if they wanted to, they could sell their portfolio positions out at the end of any particular month. That's terrible for active managers. Active managers need time. They need to be able to set up a position that might not even be super liquid, and they need time to wait for that position to come to maturity. So this trend towards liquidity has also hurt quite badly many active managers and the way that they try and work within the marketplace. Third thing that this paper talked about is safety. Many investors, institutional and retail, are looking for those large blue chip investments because they're looking for the safety, right? And this is called a flight to safety. 2008 caused many people to just flight in all different directions, but in particular a flight to safety. So this has been a flood of investment money from more active management, where you're into maybe smaller, less liquid stocks, into the large blue chip stocks. And you know what those are? Those are basically the backbone of the investment indices. So whether you buy an index product or whether you do a flight for safety into a blue chip, that's going to take pressure off of the active managers. So that's the third trend. The fourth is regulation. You know, the U.S. financial system really failed us in 2008. We saw some fundamental failures there. And so the U.S. government stepped in and they increased regulation to a level we've never seen before. This is going to slow down a lot of active management. So these things all come together, creating a perfect storm, pushing many active managers out of actively managed strategies into either indices or index-like products and procedures. And it's really giving those that are left doing deep research, doing active management, a less competitive marketplace to hopefully outperform the market. And this is exactly the kind of information we want to pass on to our clients in 2010. We want to give them the confidence that the active managers we're choosing on their behalf are going to have a really good chance of outperforming this year. And I certainly believe that that's the case.